So my name is Drew. I'm from BO Harris Bank, along with Christy Ford, also from BO Harris Bank. I'm the banker there. She's a mortgage loan officer. Also, Brad is one of our staff members over at BO Harris as well, with the downtown office. We brought a few other friends with us today. This is Mike Lynch. He's from Trinity Enterprises, and what they do is credit repair restoration. And this is Joe Collier, and he does home inspections. And he's got a lot more intel on that. He's actually kind of jack of all trades, but he'll give you some more information on that as well. And this is Jake Zafilla, and he is a roofer. So what we're going to do is just kind of give you guys some information. We invited you here today because, you know, in this area, especially in Florida, you know, there's 900,000 homes in the market roughly. So everybody kind of at this point in time, you know, has an opportunity to say, hey, you know, if I want to buy a home, you know, there are homes available. Now, how do I get into a home? And that's where we come in. We do these seminars because we want to give you guys the information, the tools, and the resources that you need in order to get a proof of mortgage loan, in order to get into a home, or maybe you have friends or family members. You know, maybe you already own a home, or maybe you don't want to, and you have friends and family members that do need help with as well. So that's what we're here for. To start off, I'd like to have Mike speak. He is going to tell you a little bit more about what he does and kind of give you.
Cool. Thank you, Drew. Thank you guys for setting this up. We did one a couple months ago. It was awesome, and it was a good turnout again. We thank you guys for coming. I wanted to ask, does anybody know, I do credit repair. If you didn't hear, does anybody know what credit repair means? Anybody heard anything about it?
I know I need it. I don't know.
Say it again.
I said, I know I need it.
You know you need it. Okay. Okay, fair enough. Fair enough. That works. Anybody else? Not much. Credit repair, essentially, if you think about it, it's a removal of negative items from a credit report. Now, you probably know that already. The reason that people use credit repair, the reason that people need it is because.
Yeah, they're gonna show up.
Oh,
when
okay.
I talk to two people, like show up.
Sure. Come on. How are you?
No.
Oh.
That's okay. You do.
That's great. So the reason that people use credit repair is it's mainly credit scoring. Your credit scoring is almost like a GPA. We all know we went to school, we have a grade point average, and essentially it starts at a 4.0, right? And as we don't get straight A's, if we get a B or a C or a D, that will lower. And it's the same thing with your credit score. You have a top end of about 850, and if you have negative items in the credit file, you don't do things correctly, that score is going to come down. The one thing that works to our advantage is your scoring models are only based on when you pull a credit report. It's an algorithm, and it doesn't know what was there yesterday, and it doesn't know what will be there tomorrow. So we can make a change. If we can pull something off your credit report, we can get you back the points that you lost, rather than you sitting and waiting the time frame that the credit says, which is 7 years, for things to fall off the credit profile. So that's what we do for folks. We do a money-back guarantee. We pull negative items off the credit file. And so we'll be able to look at helping you guys out if that's something that you think you need. And I'll be even going to pull credit reports today for folks. We charge $25 to pull it, but I can do it. We can see where you're at. Drew can look at it as well. Christy can look at it. We can get a plan together for you. Because if you're behind credit-wise, that's the place to start. Any questions?
You said $25?
To pull a credit report, correct? Yes, ma'am. Anything else?
Okay, and how much is it going to cost?
The cost range, the retainers, the full retainers are from $450 to $650 for full 6-month contracts.
So during that 6-month period, then, if there's anything that's on their credit report, it's going to not show up so that they get a higher credit score, so that when I look at their credit, it looks...
Exactly. What we want to do is go in and pull off as many negative items as we can, and I'll give an example. A lot of people have collections on their credit profile, things that they maybe didn't pay in the past, and they did some collection agencies, so those are on there. So the typical process they go through is they say, well, I'm going to go and pay those, and that'll help me out. And that's a logical approach. That's what everybody does. But at the end of the day, it's not going to come off the credit. You're not going to gain back those points. Your GPA is not going to raise back to where it was. So removing them is, yes, going to do that, help you increase the score. And which is why I work with Drew. Is part of that is you have to rebuild some credit. You have some people don't have things on there that are positive. So Drew's going to talk about what he does in regards to that, but pulling them off is the first step. Our guarantee is to remove the majority of them. Everything is based on laws and procedures, so nothing is 100% when you're dealing with that. They'll probably be able to validate some things, but for example, a collection agency is a third party. It's not the original creditor, so they really don't have a right to your money. They really don't have a binding contract with you. They really don't have a right to be on the credit profile. So they're pretty easily removed. So most folks that have things like that on the credit file, they're gonna come off, and it's gonna give you a much needed and much quicker improvement in your credit than you would by sitting and waiting for something to happen on its own.
Yes, Becky.
So you're saying that he's upset, I know some things that need to be cleared off. If they clear them off, it doesn't automatically carry the language right now.
If you pay them, they'll remain behind and it'll still be a negative. For example, you had, if you have something that has late payments on it, if you have something that has late payments on it and you catch it up, you begin to pay on time, the late payments are still going to remain behind. If you have something, right. If you have something that, say, charges off, say I have a credit card, I don't pay it for a period of time, they're going to charge that off. They're going to write it off, it's going to go to collection. Say, eventually I pay the collection agency. But those two items, that charge off and that collection agency, still sit there. And I've lost part of that GPA, part of that score by those negatives happening. So what happens is you pay them, and that's absolutely better than unlimited. And you're going to gain back a few points in the long run. But it's going to sit on your credit history, just like good credit would. That does the same thing. And so it keeps you down. And so you can sit for years and years and wait for it to get better. And it creeps slowly up. And so that's unfortunate if you're a person that's in a good spot, a good position to buy a home, you make the money, you have the job that you need to, but you really are the only other things that are in place aside from credit. Why shouldn't you be able to do it? So again, that's what we want to do is if we pull them off, remember that algorithm has no idea what was there yesterday. So if I can pull it off and we re-pull a credit file, you gain back everything that you lost when that item hit. In fact, put it this way, I'm not an advocate for people not paying their bills, but if it's with a collection agency, don't pay it. You're not helping yourself any. You can actually only hurt the credit file because you make it actually a little bit more difficult to remove. You can bring it more current if it's an older debt. So that can actually hurt you. So you leave those type of things alone. But case by case, pull credit and see what you have there. And, there's different things, different paths for everybody to take. And so some things I can help with the entire report. Sometimes there's things that you need to do on your own too to help us or me or yourself to get to where you want to be.
Basically, what happens is like maybe problems start to go down. This might go working on my husband, so you can't pay bills and custom things, so you have to shuffle and make sure you pay what is necessary. So credit up there very good, but just start to go on because late payments and stuff like that. So just like when you want to know and then catch myself, that I go ahead and clear off and then, but if it's telling me still not getting removed, you don't carry that clear.
You want to be cautious. You want to pay people that you owe. If you have a cell phone bill or a cable bill or a credit card bill or a medical bill or anything that you owe, pay it, absolutely. But the line in the sand is if it gets sold, and you'll know it because you'll have somebody contacting you from a different company, a company that you don't recognize, did not render a service to you or loan money to you, and that's when you get into a situation where they really have no legal leg to stand on. And so whether they're contacting you or they're on your credit file, there's a way to combat that. But if you pay them, you feed into what they're doing. And then we would go and say, for example, if you hired us, well, you have no way to bind me to this debt legally, and they're going to say, well, you paid it, so you must, you're claiming it, you see. And then again, your payment helps you slightly, but in the long run, you don't really ever gain back what you've lost.
Because what you're saying those things look sense to me, but not knowing that I'm just trying to clear off the way. Oh, if you say that they have a bill, you should do that. I would be trying to clear them. But what you said.
Right. And you're taking the morally, ethically correct approach. You're taking the logical approach. You're taking the approach that I took. Even when I did mortgages for years and years before I ever dived into credit repair, and I dealt with credit and I didn't know these things. I was trying to go and pay my things. So I thought, okay, well that's what I need to do. I had a bad run and now I'm on my feet, let's go pay them, or I've got some money, let's pay them, and I didn't know that wasn't going to wasn't gonna tell me. It's why I believe in what we do. It's an unfortunate thing that people are gonna take time and money and effort and put it into something that doesn't return you what you should get out of it.
Okay.
Because what happens is, what I see on my side when I'm doing your mortgage, I pull your credit report, and while you've paid these items, it still has that on there that you were 3 times 30 days late, 2 times 60 days. I mean, it shows that. And that can, and then if I look at your credit report, it gives me an explanation and points as to why your credit score is as low as it is or as high as it is. And it gives explanations, and it goes back to serious delinquencies. And that's one of the largest things that I see as a mortgage banker on the credit report is serious delinquencies. Even though they may be 4, 5, 6 years old, they're still damaging your credit scores. And like Mike's saying, I did the same thing. I didn't know. I was young and dumb and had fun with a credit card right out of college, and then change, so I've been there and done that. But in order to get my mortgage, I had to go back and get it removed so that my credit score came back up to where it needed to be. It had been paid. It was just haunting me. There's a skeleton in your closet.
Yeah, but and then not have that information, you'll be
Absolutely, and that's the purpose of these seminars, is so that we can help you understand, the ins and outs.
I have a question.
Yes.
Like, for instance, you have a delinquency, but they send you a letter, and you say, "Don't make a deal with you. Let's pay this because I need help." And you pay them, but someone told me before you can pay them, or before you pay it, you can ask them to remove it off your credit or show as if it's not a bad debt.
Pay it in full.
Or you didn't owe it, or
Yeah.
something like that.
Before you pay, you have the leverage, so you can always request that, and it is in the realm of possibility, and I see it happen all the time. It's usually, I want to say maybe 20 or 30%. 2 or 3 out of 10 is going to accept, and they're going to be willing to do that for you. And if you can get that, that's fantastic. The only issue with doing that is, if most of them, it's a numbers game for them. So they're prying and poking and seeing what they can get. And they'll send out a letter to everybody. That's an easy way to do it. And if you start calling them, they know you're there. And then you kind of stir that pot. And sometimes you can make my job more difficult if they don't, right. Usually what I tell people is, if you're in that position, if you have things like collections, you're a right candidate for what I do. Come to me first. Let's take away what I can. If you have a 550 credit score and you have 20 collections, and I can take away 15 and bring you to 630, and you need another 20 points or 30 points or 40 points to get them work. Now we can start going to the companies that we couldn't remove, because they probably won't all go away. And we can say, okay, we'll pay you, but we want to get a removal, and I can help you or anybody that's doing it, make those phone calls, give you advice in regards to what to say.
What we want to go ahead and do is move on to the next subject. Because we're running short on time. We'll go ahead and have Christy talk. We can, afterwards, we'll have some Q&A session. We can talk a little bit more about it. But also, we're here and we're giving you guys all of our information so that you guys can come, meet with us. You can sit down in our office. We can have a lengthy discussion about this. You can ask as many questions as you want, and we'll keep it going. So without further ado.
Hi, thank you. My name is Christy Ford. I am one of the mortgage bankers for BMO Harris Bank. I service several different locations in the Central Florida market. When you're purchasing a home, it's one of the largest decisions that you're ever going to make. Making sure that you have the right team in place before you do that is crucial. Making sure that you understand that your credit is going to drive your interest rate. The interest rate is the rate that you're going to pay on the money over the life of the loan. So if your credit score is down at the 640 mark and you're looking for 97 to 100% financing, your interest rate is going to be much higher than if your credit score was at 680, 700, and you were going to purchase that same home with the same down payment portion. What I have done today is I put together, in the packet, there's a glossary of terms, and I learned from our last presentation that when you start talking about a mortgage, there are a lot of terms that people use that are very confusing. So what I did was I broke down what the different types of mortgages are. We have the fixed rate mortgage, which is just that. It is fixed for the life of the loan. If it's a 30-year, it means the loan rate, the loan is for 30 years, the rate is set for 30 years.
Real quick, everybody's got one of these packets
sorry.
inside of your bag. Grab the folder out of your bag and you have a little, there's a little package.
If you want to read along with me, great.
You can follow along.
Yeah, and there's spots for notes in there as well, but I see everyone's using their notepads. Good idea, Drew. The other mortgage type that is the most common in today's market is an FHA mortgage. With an FHA mortgage, that allows you to put as little as 3.5% down on a home to purchase the home. It's insured by the Federal Housing Authority, and there is private mortgage insurance on it automatically. Private mortgage insurance is insurance that basically secures the bank for it's insurance by a private company to protect the mortgage lender against losses. So, God forbid, with the situation that most homeowners are in right now, if they're losing their home and they have private mortgage insurance on their home, those companies are having to come back and pay the banks for the deficiencies on some of it, not all of it.
Say it again, please.
Yeah,
If you have insurance, I can help.
It's mortgage insurance, yeah, mortgage insurance, not homeowners insurance. There's two different types of insurance when you're talking about a home. One is mortgage insurance. It protects the lender. It protects me, the bank, if you were to default on your mortgage. Homeowners insurance is insurance that protects both of us in the event of home catastrophe, hurricane, tornado, mortgage insurance is what you're looking at right now.
Okay, but why?
Is it factored into your mortgage?
It is factored, but no.
Homeowners
Only mortgage insurance is factored into your mortgage. You are required to pay it because you're not putting a lot of money down.
Okay.
Yeah,
It's the bank's protection.
I mean, why should I spend money paying our insurance to protect the bank? You know what I mean?
If you don't have to, if you have 20% to put down.
Oh, so if I put 20%
If you
down,
put
I don't have
20%
to.
down, you're going to avoid that private mortgage insurance, that mortgage insurance.
Okay.
But the less money that you put down, the higher risk you are to the bank. So that's what private mortgage covers. It protects us against the lower down payment homes.
Okay.
So if you have 20% to put down on a home, you don't have to have mortgage insurance.
Otherwise, I have to.
Otherwise, anything over any 80.01% financing, and you have to have mortgage insurance.
I didn't know.
And mortgage insurance goes on both the fixed rate conventional mortgages as well as the FHA mortgages. And by the way, FHA can be a fixed rate mortgage as well. We do have 30-year fixed rate mortgages on the FHA.
Now, once you've paid in, if you went FHA and put 3.5% down,
Right?
you're paying for mortgage insurance.
Right?
Once you reach 80% paying back to the bank, does that mortgage insurance amount go away?
No, it does not. Not unless you have,
The term?
not unless you have an appraisal done to prove it. With an FHA mortgage, private mortgage insurance does not automatically fall off. It would stay on for the life. If you got a 30-year fixed rate FHA mortgage and they say it's 78%, it can be removed, but unless you have an appraisal done to have it removed, it's just going to stay in place, especially, unfortunately, in the state of Florida. Our values are going like this. So, it's
Kind of hard to get.
It's
percent
very,
on a
right.
3-year-old.
You might purchase a home tomorrow that you put 20% down, and then 2 months from now, you could have lost value in the home. So, it's just the market. It's not a bad thing. It happens every day. even when the times when our market's more stable, it happens. I'm not gonna go through all of the other definitions for you, but these are key terms that I do want you to familiarize yourself before you sit down with any mortgage lender
Okay.
or realtor, so that you understand when they are asking you questions, what exactly they're looking for, or what they're talking about. The portion that I really wanted to go over with you guys today is this blue handout, and it's called the 5 Simple Steps. BMO Harris Bank, over the last couple of years, has taken a 9-step process, and we've decided that trying to explain to somebody that's purchasing a home for the first time 9 steps is really kind of cumbersome. So we broke it down into a simpler 5-step. And the first step that you're going to see here is called the pre-qualification. On your pre-qualification, what you're going to need to do is to sit down with me. We're going to discuss your credit. We're going to discuss your income. We're going to discuss with you we're going to go over your credit report. We're going to go over your income. We're going to go over how long you've been on your job. Are you salary? Are you hourly? Are you commissioned? We're going to go over all of those details in very detail to determine exactly what you get to bring home per month. Do you have child support? Do you have alimony? Are you required to pay those? If you're required to pay those, we have to put those in another column called the debt pad. So this is just our initial conversation. We're going to go over what you have as far as monies in the bank to use for a down payment on the home. I'm going to do all of this before we even pull your credit, because when we pull the credit is going to be when you're ready to take that large commitment and you're going to be moving to the next level. We're going to, at the same time, we're going to look at what product is going to fit for you. Do you have the 20% to put down? Do you need to go with an FHA mortgage, or would it benefit you to go with the FHA mortgage with just putting 3.5% down? Maybe you're looking to purchase a home that doesn't have a lot of issues. There's cosmetic things that you want to change. So you want to save your money so that you can use it for those cosmetic changes. Once we've done all of this and we know where we stand and we're on a path, and maybe we've put a plan together, say for the next 3 months there's credit issues, or something that we need to work on that you're aware of. 3 months or 6 months, however long it may be. Once we've cleared those, we're going to move to the application process. And the application process is where I'm going to take all of your information and I'm going to put it into the computer system, and I'm actually going to pull your credit. I'm going to verify your income. I'm going to verify your assets. I'm going to also look at verify your employment history, how long you've been at your current residence. We like to see a 2-year residency and consistent 2-year period at least 2 years, just to show stability. Once we've done all of that, we're going to then select our product and look at our interest rate, and then put all of that into the computer, run it through a process, but I'm not going to go through all of that with you, and then I'll be able to tell you exactly what you're going to be approved for. That is when my processor at that time is going to take your file, and they're going to ask you if there's any additional information. Sometimes there's things on your credit report that are new, and new credit hurts you right before purchasing a home just as much as old credit. If you know that in the next 120 days you're going to be going out and purchasing a home, do not apply for credit. Don't apply for a credit card, don't buy a new car, and I mean unless it's an emergency, but know that those inquiries are going to bring your credit score down, for one, and 2, they may not report right away on your credit report, and they're going to cause you to have to write a letter of explanation, contact whoever gave you the credit get a letter from them showing how much your credit is. You don't have any credit, you don't have anything reporting on your credit showing you what your monthly payment is. So we have to take a higher percentage, an estimate of what your payment is going to be. And it could, in some instances, push you to where you now cannot qualify for the same amount that you would have been able to qualify for had you not done that. So if you are ready to move forward and you're going to be using the next few months to get your credit straight or your savings in place or whatever it may be, don't open any new credit. You're only allowed to repair credit.
So you know, like, maybe a time frame that they should be 6 months, 12 months?
120 days is is when it's going to give me a notice on your credit report that you've had new credit pulled. 4 months.
Feeling like both left.
See? Once we've collected all of your 2 months of pay stub, your 60 days worth of bank statements, if you have a 401k, your most recent quarterly statement, if you're going to be getting a gift from a family member for the down payment, if you're going to be using down payment assistance for your down payment, once I have gathered all of that information, I send it over to my processing team. They're going to verify all of that information. They're going to then send your file to our underwriter. They're going to be the one that says yes or no. Or they come back and say, let's take a look at this person borrowing this amount of money versus, $150,000, let's go to $120,000. We do all that legwork up front, but sometimes it still does get kicked back when we get different scenarios pop up. Once they've done that, they're going to give us what's called a loan commitment letter. Once you have and that is telling you that as long as everything stays, you stay with your same employer, you don't fall, your credit doesn't change, and you keep the same amount of money in the bank that you told us when we approved you, it is a letter that you're now going to be able to take and turn to Jacob and say, let's go look at homes. It shows Jacob that you are, it is the fun part, it's the fun part, but I'm more fun than he is, so even spending time with me going over the boring stuff is more fun. It shows him, he knows that he has a qualified buyer that's contacting him, that when he's going out to take his time to show you homes, and that's what your realtors want to see.
Okay.
Because their time is their money. So the first steps in the process, just to retrace, would be either if you know you have credit issues, it's going to be to start with Mike, and then Drew has a program that he's going to explain to you.
Okay.
Then it would be myself, and then it would be Drew,
Okay.
and then Joe.
Okay.
So with that, does anybody have any questions for me?
I have
Sure.
what's the difference between those? I mean, are they cheaper, the FHA?
FHA
Yes.
or our conventional mortgage?
Yes.
What do you mean, are they cheaper?
Because I saw something HDA, what is it? I can't remember. The
USDA? USDA is
two, right?
there's
Government?
there's FHA,
FHA.
there's USDA, and there's the VA. There's 3 different types of loans that the government offers. USDA is going to be determined by where you're purchasing the property. And that's going to be more of your rural areas, your outskirts of town properties. VA, you have to have been in the military and you have VA benefits. FHA, you can qualify for as long as your credit score is a 640 or above. One thing I did forget, and I mentioned it to Faye before the rest of you guys got here, we have an amazing program right now that is called the LMCT, which is the Low to Moderate Census Tract program. What that means is that if you were to go out with Jacob and find a house that falls in a certain zip code, has nothing to do with your income at all, it's where that house is located. go under contract, and I know you guys are gonna look at me, after I say this, but if you were to go under contract between now and the end of May and close by the end of June, we will give you $2,000. It's here, you're purchasing a house that falls in this area, and it's not homes that, like I was explaining to them earlier, it's homes that were hit hard, the areas that were hit hard with the foreclosures. And it was based on the census tract from 2010, which is when the market was coming down, crashing. So, you know, when people come to your door and they want to know how many people live in the household, you know, what your income is, how many adults, how many kids, how many people are working, that's the census tract. And that's what they're going by to determine if the homes fit in a certain area. And it's $2,000 free money. And that's a program that is a BMO Harris program. We also do have other first-time home buyer seminar or first-time home buyer programs that are available to you, but right now this one takes the cake. So if the next few months are promising to you, we'll get you moved through, get you where you need to be, and we'll get working on it right away. If not, when the time comes, we'll see what we have to offer. We're always offering different programs for first-time home buyers.
Because we do the pre-qualification, right? If my credit is good and my husband's credit is not good, it's going to affect it?
Absolutely. If you have good credit and your husband has bad credit, we're going to go with his lowest middle score. So even though your credit is good, his low is going to bring the whole package down.
Okay, but he can't, I mean, can I buy the house, if I have good credit, can I buy the house on my name only?
As long as your income supports the mortgage, absolutely.
I don't have to choose his bad credit, right?
You don't have to use his bad credit, but at the same time, you cannot use his income or his assets unless it's joint assets. But if it's his income and your credit, those days don't exist anymore. Yeah, those days do not exist anymore. Those were the days that got us in the problem that we're in now. So in order for you to qualify, it has to be based on your employment, your income, your assets, and your credit. Joint, it's both. It's all for both. Great question. Anybody else?
Yes,
You said he's the one that, what about bankruptcy? How does that?
Bankruptcy doesn't get removed from your credit, does it?
Correct. That he can.
You can remove anything, but that's, you want to do that later. I can talk to you about it.
Okay.
Yes,
Yeah.
right now, as far as my guidelines is that you have to be out of bankruptcy for 4 years before we can move forward with your mortgage.
I'll tell you.
New credit,
New
I'm
credit,
gonna cover that in my.
Drew will
That sounds
definitely.
like a good segue into, what we're talking about. If you want to turn to the page that says types of credit, it's right after the last page of terms on there, so it's like page 6-ish. Types of credit. First of all,
Let's take a break and do something fun.
you want to do a raffle?
Yeah, I think we need to do a raffle, don't you guys? It's not too bad. Everybody has a ticket, right? Okay. I'm sorry, I had to break the monotony for a second. I'll sit here and talk for a while.
Oh, yeah.
I don't have one. Oh, wait. Gotta do this fair and square. Are you the only one that doesn't have one in the room?
Brad doesn't know.
I don't have
Practice, you guys are qualified. You're supposed to give me a raffle or a prize. And, sorry. Everyone good?
Yeah.
What prize?
never pick mine.
Yeah.
This one?
Yeah. What do you know?
Do you want to go first, Mike?
I'm-
This is courtesy of Mike. This is a $30 Target gift card, and it goes to 591258.
Say it.
258.
To start it.
258. Okay, your name?
Sonia Crafts.
I'm sorry.
Sonia Crafts.
$10 iPhone for iTunes, iPhone, $10 iPhone, wouldn't that be nice?
iPhone
591260. Yay! There you go, take that, thank you. And your name? Marie Montour. Montour, yes. All right, well, let Drew go back to boring stuff now. I'm just kidding.
Yeah, okay, so, we come out here, and, like Mike was saying, we really, we team up, we partner here together, in trying to get you guys, to, an end result, which is to be qualified, for really any kind of credit, that you might want. In this case, we're talking about homes, and so we want to get you qualified for a home mortgage. Right now, I think it's, 640 is the minimum that you need, so I mean, it's not incredibly high. You don't have to have perfect credit to get you where you need to be in life. I don't want you guys to, a lot of people really think that. I sat with hundreds of people in my office. We sit down and they think that, they're like, well, my credit's this, but I don't know if I'm going to be able to do whatever. And I'm like, actually, we can work with that. So it's really trying to get you in a position to do it.
Did you get business?
Yeah, so it's really trying to get you guys in a position to where you can get, accomplish the goals that you have in mind to do.
Thank you so much.
And I'm going to just kind of go over briefly why credit's important, what makes up your credit score, and what the different types of credit are, and then some options that we have that can help you guys get okay. So talking about a type of credit. The first type of credit that you would deal with in life is revolving credit. Everybody, I think at some point in time, has had some sort of experience with this. Revolving credit is like a credit card, or a store card, which would be like Macy's, Dillard's, Target, Walmart, any of those store credit cards, Home Depot. Those are all revolving lines of credit. There's a limit on the amount that you can borrow, and you can borrow as much or as little as you want at the time, all the way up to whatever limit they give you. You guys are familiar with this. You can repay the money you borrowed all at once or a little over time. If you pay back a little at a time, you have to pay the interest on your remaining balance on the amount you still owe. And this is where a lot of people find themselves getting in trouble. Particularly about probably close to 10 years ago, a lot of institutions were throwing out like $10,000 credit cards. Like, here you go, it's a $10,000 credit card, just for being 18, kind of stuff. So it tends to get people in trouble because they think, they see that this wide open line of credit that you can use, and what happens is that you start to get behind the eight ball. Remember that your monthly payment really is based on what your actual amount is owed on that card, okay? So if you owe a little, your monthly payment will stay small. If you owe a lot, your monthly payment is going to be big. But not only that, you have to pay finance charges and interest charges on that card or any kind of revolving line of credit. And the way the interest works on a credit card is that whatever balance you carry from one month to the next month, if you continue to carry balance, you have to pay interest on that money that was used that month or that balance that was used on there. So your interest rates on credit cards can range anywhere as low as 0%, which are promo rates that a lot of banks do and a lot of places do, or after that promo time, it goes usually about like 7 or 8%. Your really high-end cards, if you have really good credit, maybe 5% would be low. But they can go all the way up to 35%, 36%. What's the highest interest rate you've seen on the credit card?
I think 37 or something.
37. Yeah, but think about it in this terms, 37% on a credit card, that's a lot of money that you'll be paying. And over the life of the balance on there, let's say you have, $5,000 credit. I'm not going to do this math in my head, but let's say you had a $5,000 credit card and you spent that $5,000. Do you have $5,000 to pay back right now, right then and there? Anybody just want to pull that out? No. The reason why you're using a credit card is because you didn't have the cash in the first place, right? Exactly. So this is where you get in the pickle. So now you have this massive interest rate you're paying, and annually the interest rate is much higher. That's just the interest rate on the monthly ongoing. But annually, I'm going to use a big word. It amortizes, and it can really end up costing you double the amount that you spent in the first place. And so that's where you get yourself in trouble. That's where the disconnect happens, and we got to bring in We'll talk about that in just a minute. So, let's go to the next page. Different types of credit installment loans. This would be, you sign a contract, you borrow the money for a certain amount, you agree to the terms of that. Monthly payments, same amount every month until the loan is paid. Automatically pay interest, which is built into the payment itself. And then the interest, the example would be car loans, any kind of car loans, but also like mortgage loans or installment loans, your personal loans, installment loans, anything that is, when you walk in and you say you sit down with me, because I'm the banker, anything where you sit down and you say, I want to borrow $10,000, I'm going to pay you back over the next 2 years. That is an agreement. That is a contract. You put pen on paper, you sign it, and you agree to pay me back 24 months, $10,000, or whatever amount that you would have. So that's an installment loan. It's drastically different than a credit card. First, installment loans, aside from personal loans, are usually secured by some sort of collateral, i.e. the car, the vehicle, the RV, the house, the raw land, real estate, even a business, a commercial property, any property, anything like that. Property can be used as collateral. That way, in the event that you default the loan, you can either take the property, which would be like a repo or something like that. But other than that, personal loans, personal unsecured loans, again, those are specific amounts of money that you get for a specific amount of time. So you say, I need to borrow this now, you get the money today, you pay it back over the time. Versus a credit card, you pay back to keep using it, pay back to keep using it. It's a seesaw. So, any questions? Yeah. Very good. What makes up your credit score? This is really important. If you guys want to turn to that third page there of the credit side. Really important. We started, this is what we kind of did really early conversation, because we actually have a nice little breakdown here. You can see what actually goes in as the factors to make your credit score, to tell you what your actual credit score is. So you can kind of get a rough idea in your head of whether or not you're doing well, whether or not your credit's high or low. And right now, if you kind of take a look there, you see 35%, which is the largest chunk, is your payment history. And what affects your credit score today is a track record going back about 24 months. That's the majority of what affects your score today, is the last 24 months of payment history. After that, it doesn't cut as much as question.
Yeah, I understand that. I said that too. So I was referring to like, okay, my husband, really started to work. I mean, he wasn't, everything was in me, for me, all along. So I'm like, I go forward, I take blah, blah, bills, blah, blah, blah. So it's like, how do we restart his credit? Because he has...
How do we restart his credit?
How does he build it? Because he doesn't have it.
How does he build credit if he doesn't have it? Okay, I'm going to get there in just a minute.
Okay.
Hold that thought for 2 minutes. Okay, so, payment history, go back 24 months. Amounts owed, and that's your balances, are really, when it comes to, the reason why amounts owed is so important is because when you say you sit down in front of Christy, and you're trying to get a mortgage loan, and she asks you, how much do you make? And you say, I make $40,000 a year. I make $40,000 a year. Okay, that's great. And then what we do is we look at your income, but what we have to divide with, it's like a pie. You have to divide out your bills, your expenses, your liabilities. And so you say, if you have 5 credit cards, and you have a $50 a month payment on one, $50 a month payment on another, maybe a $100 payment on the other, maybe a $200 payment on there. That's what, $400? 300. 2, 3, 400 bucks a month in just credit card payments alone. So that goes out of your monthly income. Now, if you take that, 400 times 12 months, that takes away from your annual income. So now, are you really making $40,000 a year? Now you're making $30,000. You know what I'm saying? So, and then say you have a car payment. That's maybe $250 a month. Is your car payment if you have, maybe you do a car, something like that. Then that's a liability, so that comes out. So really, when we look at that, amounts owed matters because when we sit down and say, your ability to pay me back for the money I'm going to lend you for this mortgage is based on how much you have available to you. And if you have little available, it's difficult for us to do that. So it affects your credit score, and it definitely affects your favorability in order to get approved for a loan, because that's one of the factors, one of the major factors that we look at any lending institution looks at when they're trying to give you any sort of additional credit. Because credit, in reality, is simply saying you don't have the ability to right now pay for this. I'm going to support you and help you make that payment, help you get the funds that you need. So you're saying I don't have what I need, but I want to get that. That's most people, and this is it goes back a long time in American history for us. But most people just don't simply have $100,000 to sit down. Like the problem is that in our market and in the housing market in America, homes they cost significantly more than they did 50, 60 years ago. And I mean yes, because people, money was worth more back then, so gas was 5 cents a gallon. That's not what I'm saying. I'm literally saying that the ratio of what people earned annually versus what the cost of living was and the cost of the house was like here. Now it's like here. So people make less money per cost of living now than they did 50 years ago. Does that make sense? Yeah. So it's important to know. So back then you could buy a $20,000 house cash outright because people saved money. They didn't have additional liabilities that stole their savings. And they didn't have all these different things that they basically just wasted money on. So that's kind of where it comes to. So at this point in time, there's nothing wrong with getting a mortgage and doing that, but it's very difficult to get a proof of that if you have a lot of additional liabilities at the moment. Again, types of credit used, 10%. New credit is about 10% of there, so that's where Christy was talking about. You don't want to pull your credit and do new inquiries, you can get a proof of things within 4 or 5 months of applying for a mortgage loan again, because that can pull your credit score down. So that new credit is actually that thing. If you have old credit cards, you want to keep those open. You don't want to close your old credit cards. If you have an old credit card, you have 10, 15, 20, 30 years, whatever it is, and it's in good standing, and you have a low balance on it, keep it open. Don't close it. Don't pay it off and say, oh, I want to close this site. Don't get that monkey off my back. That's not a good thing. It's considered an asset. If you have a wallet filled with credit cards that have zero balance on it, but they're all open and active, that's a good thing. Don't think that you have to carry debt with you in order to keep your credit high. That is not true. People say this all the time. Oh, you should spend the money on the credit card and then pay it off. That's not true. You can hold a card, you can have a revolving line of credit open and have no money owed on it. If you have a $5,000 credit card, and I explain it like this to a lot of people. So you make, we're going back to you make $40,000 a year. All right, now you have a $5,000 credit card. So your spending ability is how much? 45, right? If you have $40,000 cash income, and then you have a line of credit for $5,000, your total spending income, or still total spending ability, is $45,000 credit. So now you just bump yourself up a little bit there as far as what you have available to you. If you spend the $5,000 and you owe that, now your spending ability is $35,000. So it goes down, so your credit score is going to do that. You see what I'm saying? So that's where it matters. So it's good to have your cards open and active, paid off, low balance.
Below 30% or 30% of what your high limit is.
Okay, I'm just going to go real quick over this. We talked about that. If you go this is actually really important I want to talk about. Your credit can affect your employment, exclamation mark. Your credit can affect your employment. Do they do
I think they started on, not when I got hired, it wasn't doing that, but I think now they are.
Yeah, this is a new thing that's coming out there, and definitely turn to this page, check this out. You heard about this?
Yeah, every company does it.
Yeah.
Even if it's a mom and pop company, they're checking the credit score.
A long time ago, very few companies really, they only did it for their executives and stuff like that. A long time ago, and we're talking about the 90s, so it's not long ago. But in the last really 5 to 10 years, really more in the last 5 years, more and more corporations are pulling your credit when you apply for the job. They're pulling your credit. They're it's like you're applying for a credit card, and your ability to get hired can be based on what your credit score is.
But if they do that, would not that affect your credit when you're trying to buy a home?
It's a soft pull. It's not a hard
So
pull.
they don't pull.
So it affects it by a couple of, like a point or so, but it's not like being declined for or opening It's a different kind of, it's a
But
soft.
isn't it illegal to do it without you knowing?
No, you signed an agreement saying it when you apply. Absolutely.
Okay.
When you apply for the job, but you're saying, I want to apply for this job. Feel free to do what you want, background check, whatever.
Part of the background check, the background check form does now include the word credit check.
Okay.
Right there. What they do is they pull your report. They don't pull your score or anything like that. They just pull a report to see, what's on there. Now, here's the thing, and I want to read through here. I don't think I put it on this one, but the truth of the matter is I did a lot of research on this, and the truth of the matter is there is absolutely no data to suggest that your credit score has any correlation to your ability to do the job. There's no proof whatsoever on that. So, but a lot of companies use this as a way, because we have, and I have a graph for my phone, I'll show you sometime, but let's just put it this way, and to not go too deep into this, I'm just going to say, in the last 200 years, the population of the world has gone from 1 billion to 7 billion people on the planet. In 200 years. That's not a lot of time. We're talking about 10,000 years of recorded history. We have under 1 billion people on the planet. In the last 200 years, we had a spike, we had a growth of 600%. That's ridiculous. So what I'm saying is that we have so many people walking around, so many children being born and growing up that are going into the job force, hundreds of thousands more today going into the job force than 10, 20 years ago. And so there are so many more resumes on the table, they have to find a way to weed out. And so it's a real easy way for employers to simply say, all right, well, this guy had a better credit score. It's just a blind, blanketed way of doing it so that they can reduce the pot down, boil it down a little bit so that they can get something more manageable because they only have so many staff members to go to the shows. Does that all make sense? That's the reason why I do it. They're not doing it to be, to be mean or to mess with you or to preclude you. And there are very many laws out there that are anti-discrimination. You cannot discriminate as a result of sex, gender, race, whatever, nation, creed, country, whatever it is. You can't, and there's ridiculously long list of laws. Yeah, but, and maybe, maybe that's worth a lawsuit, I don't know. But, if you want to do that, I'm jumping on. But, we'll see. Okay, but let's just go punch this out real quick. 6 out of 10 organizations do credit checks. 6 out of 10. 13% of organizations surveyed conduct credit checks on all job candidates. Another 47% consider credit history for candidates for select jobs, and this is your upper management. This is your upward motion, your ability to get up into the next echelon. This is how, and the reason I put this in here is this is how important your credit is. Not only does it affect your ability to get a mortgage loan, you can always rent an apartment. God bless Gigi. This is a really nice place. You can always rent an apartment from Gigi. She's here for you. But not only that, it really affects all aspects of your life, especially in American life today. It's very important that you maintain your credit, and you know this information. This is really important information. I'm sorry, I'm trying to stress that to you. So that what I'm saying is just don't throw this away when you get home. Read it later. Okay, and now let's talk about how we can fix your credit and make it grow up. These are some things that you can do on your own without any intensive effort, just as a daily practice. Just minding your P's and Q's. And that's paying your bills on time, obviously. Pay your bills on time. Like I said, 35% of your credit score is based on the last 24 months of your payment history. If it's terrible, your credit score is probably going to be terrible. And here's the thing, if you miss a payment on say you have a car loan, if you miss a payment on that, and then you make the payment the next month, unless you make the payment for the previous month, you're going to be behind every single month until you do that, which means you have a late payment every single month. So if you had a payment due in November, and you paid it in December, you didn't pay November. So really, December's late, January's late, February's late, March is late. Every month is late until you double that payment back to the original. Does that make sense? This is something people don't realize. Okay, paying off revolving debt, we talked about this. You want to keep low balances on that.
Question about that. But if you defer your payment.
It's a different.
You're talking about student loans?
Student loans, car loans, some company like my car, I can call and say, hey, can I defer
If you do
2 months?
and because that's an agreement, you have a contract with that lender, and if the lender allows you to and says, hey, you can do a skip payment, then you're not breaching your contract, so they won't report it. Because, and this is how it works, in truth, in reality, and Mike back me up this. This is how it works. Every lending institution has to report to the bureaus. Every lending institution that reports on the books as far as like prime lenders. There are subprime lenders that do personal financing and those guys you want to stay away from. One, they don't report to the bureaus. Two, they charge exorbitant interest rates. And three, they don't really have strong credit guidelines, so they can really mess you up. And you know, okay.
It was nice to meet everyone. I
Okay.
apologize for having to go. Thank you.
But the thing is that all lenders, and we're talking about banks, we're talking about credit unions, car dealerships, the franchise dealerships, your Ford, Chevy, all those places, all of your department stores, anybody that issues some sort of form of credit, they will report to the bureaus. There's 3 bureaus: Experian, Equifax, and TransUnion. Those are the 3 main bureaus in the United States. And they pay per bureau to report your credit. So that means, like, if every single person in this room came to me and I gave you all a $1,000 credit card, I would have to pay the bureaus to report monthly on you guys, okay? Now, your larger institutions, especially your banks, will report to all 3, but not all companies will report to all 3. Some of them will have a deal with one, let's say, let's say you get a Macy's card, you know. Well, actually, Macy's does report all 3. You know, just car dealerships, small car dealerships, that they don't have the capital to be able to pay that much money to all 3 bureaus every single month, all 3 bureaus. So they will only report to one, and that's where it can really lopside your credit. That's why when you pull your credit, you get 3 scores, and they're all different numbers. They're never the same, because not all institutions report the same. Very important to know. Does that make sense? Do you guys have questions? I know you guys got to ask a question.
Let me say also, while we're on the same page, if you do that, if anybody does that, calls their creditor and says, hey, I gotta skip a payment, I've seen it 9 out of 10 times where,
Oh, I'm sorry.
come on in.
Are you residents?
Yeah.
Yes. How can
Just make sure that they're not gonna report that information to the credit bureau. I've seen it happen 9 out of 10 times where somebody calls and they say, no problem, just make your payment next month. But they really don't, you still haven't made a payment, you're still technically late, you still haven't upholded that contract, that note. And they'll report you and they just won't tell you. So ensure that they won't get a confirmation from them, preferably get it in writing, and get the person's name and information. Know that you've got it, otherwise you can pull your credit a year later and find there's
No, Mike makes a really good point on that, and the truth that some of the institutions, like for instance, Steve-O, we would send you a letter telling you, hey, you can skip the payment. This is just you've had your loan with us for such and such amount of time. Here's your bill, and we would send you a letter, and you would know it's a skip the payment. And so that actually, you would call, you want to speak directly to rep, you would know as far as the skip the payment thing we're talking about for your loan. Your bank or your lender would tell you if you have the ability to do that. And if you call and you ask, you say, do you guys have a program where I can skip payments? Don't just say, hey, I can't make a payment this month, whatever, because then...
No, they actually have to approve it.
Yeah.
And then once they approve it, they'll let me know, okay, we'll defer for 2 months, and then you can start making
Exactly. And that's different, but even then, that can be...
And just ask the question,
Yeah.
how's that going to look on my credit report? Are you going to report me late still? Because my point was to bring that back up, is that sometimes they still show no problem, but they'll still report you as a late payment, which it may be your only choice, but it's better to know that going in than...
Because then you can make a better educated decision.
Yeah.
But the thing is, because at the end of the day, they want their money. So they're going to work with you, whatever. And they don't care about your credit, they just want their money. And there's nothing wrong with that, that's what they're there for, you know? You can't hate them for doing their job. You know, so they want their money, so they say, oh yeah, I'll work with you, we'll get a payment situation, give me $20 here, $20 there. And, but that can totally break your credit. So it's important to keep it all above board. Ask as many questions as you possibly can. I find that a lot of people, I know nobody in here feels this way because everybody's here very confident, hardcore, but I find that a lot of people go into this realm of things, finances, especially in lending, and they are scared to ask questions and scared to sound like they don't know what they're talking about, you know. And so never be scared to ask questions. Never be intimidated by an institution or anything like that. You say, listen, I'm here, I'm going to give you guys interest on the money you own, or money you're going to give me, so, you know, I want to know everything about it. And spend the time, ask the questions. Ensure your credit limits are reported correctly. Absolutely. It's important to check your credit card statements. You can have a $5,000 credit card today, and say you use $3,000 on it, and you haven't made purchases on it in a year, and you're just trying to pay off that $3,000, a lot of times, especially in the last 4 or 5 years, because of the credit crisis, what companies have done is you had $5,000 and you owed $3,000, they dropped your limit down to the amount that you owe, which will destroy your credit, or can destroy your credit. And the reason why is because it goes to your debt to credit ratio. I don't want to throw out weird words, but debt to credit ratio just means amounts that you owe versus your limits on the card, and that affects your credit score. So when they drop your limit down to the amount that you owe, you go from owing 50% to now owing 100% of the line, which will credit goes down. Just how it goes. And that also affects your monthly payment. So, good enough?
Wow, landmines.
Oh, bam! It's like a financial landmine too, you know, like, I guess figuratively, the financial landmine show. Okay, ensure your derogatory items are removed. Mike Lynch. He will ensure that for you. This is his job. My job is to send you in and say, here you go, hey, this is gonna make sense. I, as a banker, and I've been with a few different banks, and I've been in the industry for a while, I can tell you this right now, this is not our job. We cannot do this for you. We cannot remove derogatory items from your credit. I do know a couple bankers, and I mean literally 2 bankers, that take extra time out of their work week to go and do this stuff for their clients. I know 2 bankers that do this. This is absolutely, and it's dangerous to do it. I would never tell a banker to do this because we can get ourselves in a lot of trouble by doing this. We can't